Warren Buffett is widely considered one of the most successful investors of all time. His investment philosophy focuses on long-term value investing, where he looks for undervalued companies with strong fundamentals and a durable competitive advantage. He also emphasizes the importance of diversification and not trying to time the market. In general, Buffett advises investors to invest in what you understand. Look for companies with a strong track record of earnings growth and a durable competitive advantage. Avoid trying to time the market. Be patient and willing to hold on to your investments for the long term. Diversify your portfolio. It's important to note that these are general principles that have guided Buffett's investment decisions over the years, and they may not be applicable to all investors, and as always it's recommended to consult with a financial advisor before making any investment decisions. One of the key principles of Warren Buffett's investment strategy is to invest in what you understand. He believes that it is important to have a deep understanding of the companies and industries in which you are investing, as this allows you to make better informed decisions. He also emphasizes the importance of looking for companies with a strong track record of earnings growth and a durable competitive advantage, such as a strong brand or a dominant market position. This is because these companies are more likely to be successful in the long term. Another key principle of Buffett's investment strategy is to avoid trying to time the market. He believes that it is impossible to predict short-term market movements, and that attempting to do so can lead to poor investment decisions. Instead, he advises investors to be patient and willing to hold on to their investments for the long term. This allows them to ride out any short-term market fluctuations and reap the benefits of the company's long-term growth. Buffett also emphasizes the importance of diversification in an investment portfolio. He believes that spreading investments across different companies, industries, and even asset classes can help to reduce overall portfolio risk. By diversifying, investors can ensure that a poor performance in one area of the market does not significantly impact their overall portfolio. It's important to note that these are general principles that have guided Buffett's investment decisions over the years, and they may not be applicable to all investors, and as always it's recommended to consult with a financial advisor before making any investment decisions. Another principle of Warren Buffett's investment strategy is to focus on the fundamentals of a company, such as its earnings, cash flow, and financial health. He believes that a company's financials provide insight into its long-term potential and its ability to generate cash flow, which is essential for a company to be able to pay dividends and reinvest in its business. Buffett also places a lot of emphasis on management, and he looks for companies with strong, experienced, and honest management teams. He believes that a company's management team is crucial to its success, and that a good management team can navigate the company through difficult times and make the most of good times. Buffett also has a preference for companies with strong and consistent cash flow. He likes companies that generate a lot of cash and have a track record of using it to reinvest in the business and make smart acquisitions. This is because it shows that the company is able to grow its business and generate more cash flow in the future. Buffett also believes that it's important to not overpay for a company's stock, so he looks for companies that are trading at a reasonable valuation compared to their earnings, cash flow, and growth potential. He also believes that it's better to buy stocks when they're selling at a discount, rather than buying at the peak of a bubble. It's important to note that these are general principles that have guided Buffett's investment decisions over the years, and they may not be applicable to all investors, and as always it's recommended to consult with a financial advisor before making any investment decisions. Another aspect of Warren Buffett's investment strategy is his focus on the long term. He believes that investing for the long term allows investors to take a more patient approach and avoid the short-term volatility of the market. He also believes that by holding on to investments for the long term, investors have a greater chance of reaping the rewards of a company's growth and success. Buffett also has a preference for investing in companies with strong and consistent revenue and earnings growth. He believes that companies that have a history of consistent earnings growth are more likely to continue to grow in the future, which makes them more attractive investments. Buffett also places a lot of emphasis on a company's competitive advantage. He looks for companies that have a sustainable competitive advantage, such as a strong brand, a dominant market position, or a proprietary technology. This is because companies with a sustainable competitive advantage are better able to withstand competition and maintain their market position over the long term. It's also important to note that Warren Buffett's investment strategy is not without risk, and it's not a guarantee of success. His approach relies on finding undervalued companies that have strong fundamentals, but even the best companies can encounter unforeseen challenges and market conditions can change. It's always recommended to conduct thorough research and analysis before making any investment decisions, and to consult with a financial advisor. This concept refers to the difference between the intrinsic value of a stock and the stock's current market price. Buffett believes that it is important to buy stocks that are trading at a discount to their intrinsic value, as this provides a margin of safety or a buffer against any unforeseen events that may negatively impact the stock's value in the future. Buffett also places a lot of emphasis on the power of compounding. He believes that over time, compounding the returns on investments can lead to significant wealth creation. He advises investors to invest in companies that have a history of paying and increasing dividends over time, because it is a sign of a stable and profitable company, and it also enables the investor to benefit from compounding the dividends received. Buffett also believes that it's important to have a well-diversified portfolio. Diversification helps to reduce the overall risk of an investment portfolio by spreading investments across different companies, industries, and even asset classes. By diversifying, investors can ensure that a poor performance in one area of the market does not significantly impact their overall portfolio. It's also important to note that Warren Buffett's investment strategy is not a one-size-fits-all approach, and it may not be suitable for all investors. Each person's investment goals, risk tolerance, and individual circumstances are unique. It's always recommended to conduct thorough research and analysis before making any investment decisions, and to consult with a financial advisor to determine the best investment strategy for your individual needs. Thank you for watching this video. Please subscribe the channel for more updates.